Thank you very much for that intro. Welcome, everyone. My name is Garrett Patton. I am a senior analyst at ElliottWaveTrader.net, where I co-host the Metals, Mining, and Agriculture service with my colleague, Zach Manez. We recently expanded the service to include agricultural-related commodities, along with other basic material stocks in industries like uranium, lithium, graphite, and other industrial miners. During today's webinar, however, I'm going to focus just on gold, silver, and GDX, which is the Van Eck Vectors Gold Miners ETF, and serves as a pretty good benchmark for the mining stocks industry as a whole. And I will also go over a few specific individual gold miners near the end. So we will be assessing both the current fundamental and technical picture for gold, silver, and therefore individual mining stocks, after which I will leave some time for any questions. So let's start off first with the fundamental forces. Gold is mainly a risk-off asset. In the long run, it is correlated to broad money supply growth, while in the intermediate term, it is more correlated inversely to inflation-adjusted interest rates. Fiat currency loses value over the long term, but in most cases is stable in the short term, whereas gold is far more volatile in the short term, but historically has held or increased in value over the long term. Due to this volatility, there are bull and bear markets for gold, which makes sense because there are environments where fiat currency is rather robust and other environments where fiat currency is being devalued. Gold is a zero yielding asset with frictional costs, but whose supply is scarce and changes very slowly. When real rates on currencies and sovereign bonds are heading lower, and especially when they are negative, gold becomes a lot more attractive than fiat currency. Conversely, when real rates are strongly positive, gold tends to be out of favor. This makes sense when a 10-year treasury offers you a 7% annual yield while inflation is at 3%, you get a 4% real rate of return. Gold would be less attractive in that environment due to the high opportunity cost of earning a strongly positive real yield with the treasuries. On the other hand, if the 10-year treasury offers you a 2% annual yield while inflation is at 4%, you get a negative 2% real rate of return, and gold is a lot more attractive in that environment since the opportunity cost is negative. So gold is both scarce and ironically higher yielding in that environment. In that sense, gold is not specifically an inflation hedge. It is a hedge against negative real rates. Albeit in practice, the deepest negative real rates tend to be during times of high and sharply rising inflation. So let's take a look first at a chart of the 10-year treasury yield adjusted for inflation. It's drawn inversely for illustration purposes. It is the red line on this chart here, overlaid with the price of gold. And it's pretty easy to see the correlated relationship between these two assets over time, with their correlation coefficient shown at the bottom. So this graph here. You'll notice that there has been an interesting divergence between the two lately, causing the correlation to break down a bit. The correlation did go negative for a brief period, but has since gone back to positive, probably mostly because of the recent pullback that we're seeing in gold. But there is still a fairly significant gap with the real rates, interest rates still trending strongly higher at the moment. Again, it's shown inverse on this chart, when gold has been moving higher during the same period. So from a fundamental perspective, there are a few different ways of interpreting this. From a bearish perspective, one could argue that shorter-term geopolitical forces have been driving the price of gold higher, despite real interest rates spiking higher as well. And once those geopolitical forces are resolved, the correlation will be reestablished and gold will correct to the downside to compensate. However, from a bullish perspective, one could argue that gold shrugging off a bearish catalyst like real rates rising is a testament to its strength and a potential market regime shift. You could even make the argument that gold is calling bluff on the Federal Reserve, suggesting that they have been boxed into a corner regarding their monetary policy. And a policy shift in planned future rate hikes, along with a plateau or decrease of inflation, would mean that real interest rates would start to fall again. And that's how the correlation would reestablish itself with gold. In the end, it does not matter, since we can use the power of Elliott wave theory and Fibonacci ratios in order to aid us in our investment decisions and tell us decisively when adjustments to expectations need to be made. So next up, let's take a look of a chart of the S&P 500 priced in gold, basically just a ratio chart of the S&P 500 compared to gold. Historically, stocks have significantly outperformed gold because they are better at exponentially compounding with structural growth and dividend reinvestment. However, there are periods when the performance of gold has outpaced stocks, and at least in the beginning half of this year, we saw some fairly significant outperformance from gold compared to stocks. You can see basically right at the start of the year here, we had that strong downtrend within the ratio chart that has just recently reversed since stocks have been rallying off of the recent March low. So it was at one point about a 15% outperformance of gold compared to stocks. It's still, so far in the year, measured from the beginning of the year, at about maybe half of that as far as the outperformance of gold compared to stocks overall. So the question is this the start to a new trend to the downside? Is gold going to continue to outperform compared to stocks overall? Or has that quick pullback that we saw on this ratio chart completed and price, or the ratio is about to continue back up and resume its initial trend that was ongoing since the 2020 low and eventually continue back above the high that was made at the beginning of the year? Even if the ratio chart is going to continue to trend to the downside, it doesn't necessarily mean that we should expect stocks to perform poorly for the rest of the year. All that really needs to happen is gold needs to outpace the performance of stocks overall. But it is interesting that recent reversal that we've seen off of the March low here on the ratio chart that does, and I'll show you this a little bit later, from an Elliott wave perspective, seem to suggest that we could see that initial trend of equities outperforming gold continue into the end of the year. Again, it doesn't necessarily mean that gold has to go down while stocks go up. Just at this point, if we're going to see this ratio chart continue higher, then equities should be outpacing gold from a percentage standpoint. So let's take a look at a technical perspective, an Elliott wave specifically perspective of gold and silver and GDX. Without diving too deep into the theories of socioeconomics or the wave principle, I'd like to offer a different perspective of what drives the price of precious metals. Since many of the widely accepted exogenous causes that are currently attributed to the price swings of gold and silver fall flat when you actually look at the empirical evidence, really the only long-standing relationship is what I described earlier as far as the broad money supply and inflation-adjusted interest rates. Consider, if you will, that the cause of a lot of the shorter term price movements in precious metals may be endogenous instead of exogenous, so coming within rather than from external influence. So Elliott wave theory postulates that human beings as a collective whole are governed in part at a subconscious level, that our combined social mood fluctuates in repetitive and predictable patterns, and that the same way that phi, or the golden ratio, governs relationships and natural phenomena involving growth and decay, expansion and contraction, advancement and retreat, the progression and fluctuation of precious metals prices exhibits Fibonacci relationships as well. The idea is that social mood governs the character of social events rather than social events being largely random or the result of external forces. Periods of positive social mood result in rising stock prices, re-election of incumbents, and economic expansion. Periods of negative social mood result in declining stock prices, rejection of incumbents, and economic contraction. So next up, this is, again, I don't want to go into too much detail regarding specifics on Elliott wave theory, but this is kind of the basic price structure that the Elliott wave methodology is based upon. This 5-wave structure to the upside that composes trending moves within financial markets, and this 3-wave pullback that comprises the counter trend or corrective moves within markets. So when you see a chart that is trending strongly in a specific direction, it should be unfolding as a 5-wave move. And when you see counter trend moves correcting the larger trend, they should unfold as these corrective moves labeled as an ABC structure. So you're going to see these 5-wave trending moves and 3-wave counter trend corrections repeating themselves in a fractal nature at various different time scales of price. So the same 5-wave structure that you see on a longer term trend when looking at a monthly or weekly chart or a daily chart, you're also going to see when you examine the smaller degree timeframes, those same 5-wave structures and 3-wave corrective pullbacks on anything down to a 1 minute, or I suppose you could even take a look at a tick chart and see the structures there as well. So basically, this 5 up and 3 down basis for Elliott wave theory is fractal in nature, repeats itself across various different time scales and kind of builds upon itself. So the individual waves themselves, these actionary waves, waves 1, 3, and 5, which are pushing price in the direction of that larger trend themselves, will break down into a 5-wave move. So you can see illustrated here in this wave 3, a 5-wave move. And then the corrective phases also have that 3-wave ABC shape to them. So again, fractal in nature and building upon itself to create larger and smaller degrees of price action. So I'm going to switch here. Bear with me while I change to my charting software. There we go. So you should see, let's start with gold. The daily chart of gold pulled up on my screen currently. And we can see that when I zoom out on this daily chart, let me actually start with the weekly chart. Price has been trending to the upside since that low that was made in 2015 and has been doing so in an impulsive fashion. So that 5-wave structure that we were looking at on that other chart, you can see here as price has been moving higher, we have that wave 1, 2, 3, 4, and price now currently appears to be working on the 5th wave to finish that 5-wave structure up. That will complete the structure from the low that was made back in 2015 when price completed its most recent bear market. And you can also see that the subwaves within the individual waves here themselves, again, fractal nature, break down into 5-wave structures. So we have the 1, 2, 3, 4, and 5 waves within that primary wave 3. And so far, price has been working well within an impulsive count. Again, I don't want to get too deep into the individual nitty gritty of Elliott wave theory, but there are 2 variations of those 5-wave structures. There's an impulse and there is a diagonal structure. And right now price is following the impulse, which is usually the easiest to navigate and trade within. So right now, the waves 1, 2, and a portion of the wave 3 within the larger 5th has filled out. The high that was made in March appears to have completed the wave 3 within this higher degree wave 3, and the recent pullback so far is holding support where we want to see it hold support for a 4th wave. That said, we do need to see a little bit more evidence off of the low that was made last week in order to confirm that price has put in that bottom as wave 4 and is turning up in the starch to the wave 5 of 3 here. Really what would accomplish that is price getting back above the high that was made near the end of March at 1966. If it can successfully do that, then it would indicate a near-term trend change. So the pullback down from the March high complete and price trying to turn up in the starts to this wave 5 here, and should still be working on the, again, subdividing into a 5-wave structure, this 5th wave, it should still be working on the wave 1 of that 5th. And this wave 1 itself also should take shape as a 5-wave structure. So needs to fill out the 3, 4, and 5, get 5 waves up off that low, and it would be good confirmation again. The 4th wave here has completed and price is ready to resume higher in a 5th wave. Even from a trading perspective, if you attempted a long at current levels instead of stop underneath the March low, the risk of the invalidation of the start to the wave 1 of 5 here would be about little under 2%, whereas the potential reward from that level heading up to the target at 2150 for that wave 5, closer to 12%. So decent risk reward profile for that setup. But again, not confirmed yet. Want to see that 5-wave structure to the upside as the wave 1 of 5, and want to see price get back above that high that was made at the end of March. So let's take a look next at silver. In this case, it can also be working on a 5th wave in that started from the December low. Again, gold bottomed back in March and has been making higher highs and higher lows since then, where it can count as a wave 4 complete. And in the case of silver, it continued to make lower lows into December and has since been trying to move up off that December low. So that's where the wave 4 is counted here on the silver chart. Price trying to fill out the 5th wave at the moment. And remember when I mentioned those diagonal structures, they're a little bit different than impulses as far as how the subwaves unfold. Instead of 5-wave moves, they unfold as 3-wave structures, but still the same larger degree 5 up here to complete that wave 5. And currently working on the wave 2 within that 5th. It's been a little bit weaker in comparison to gold off of the low that was made last week. So far, it's trying to hold a higher low, but it got a lot deeper in the pullback into the low that was made this morning. So even more so in this case, I think we need some better confirmation that the pullback off of the March high has completed as this wave 2, and price is ready to head higher in the wave 3. It is possible that it does want to stretch a little bit lower near term, undercut the low that was made last week, and potentially head to the next support levels here in the 2340 region before that wave 2 completes and turns up in the wave 3. That said, I would view any break back above the high that was made yesterday morning as a pretty decent indication that the bottom is in place and price is trying to set up that next move higher. Obviously, much better confirmation above some of the later March highs as well. We don't need to see that same initial 5-wave structure off of the low here that I was showing you on the gold chart, the 5 waves up for this wave 1 of 5. Again, because of that larger degree diagonal context, the subwaves aren't going to be expected to unfold as 5-wave moves. This third would unfold as a 3-wave move. It might be a little bit confusing. Again, if you're interested in Elliott wave theory, we have lots of educational materials on our site, and it would make a lot more sense. Or if you are familiar with Elliott wave theory, you probably know about diagonal structures and again, they're ABC subwaves. So let's compare that now to the GDX chart. I'll start here with the daily as well. GDX, similar to silver, continued to head lower following that initial bounce off of the March low where gold bottomed, making lower lows, even in this case, into the low that was made in January, basically a double bottom compared to the December and the September low, but I do believe it was a few pennies lower in January, at least during regular trading hours. So that's where I'm counting the bottom of the pullback here off of the 2020 high, likely complete. We've already achieved some initial evidence, confirmation of a trend change, that pullback complete when price exceeded the November high. So it's made a higher high. Next step is just making a higher low on the current consolidation. And there's kind of 2 variations of how the subwaves off of that January low can count. It does look like we're working on a wave 1, somewhat similar to silver. There is room in this case to pull back more in the wave 2. So that ABC structure for pullbacks could be only finished so far with the A, B, and needing the C wave. back down that will take price probably to the 36 to 34 range before completing. And it should remain below the high that was struck yesterday if we are going to see this blue path play out and fill out that C wave back to 36, 34 before resuming higher. Any break back above yesterday's high, and especially above the resistance here at about 40.50, and it would suggest prices more immediately bullish, either already complete with a 1-2, working on wave 3, or another alternative I would consider at that point is maybe stretching a little bit higher in wave 1. All of these options, though, ultimately are bullish based on the Elliott wave perspective and based on the price action that we've seen so far since the low that was struck at the end of January. It has been maintaining bullish posture and doing what it needs to do in order to continue to expect further upside overall. So again, we can consolidate a little bit more in this region, but it does look very promising for holding a higher low and continuing higher into the end of the year, and more likely than not, eventually getting back above the high that was made in 2020. So let's take a look at some individual stocks. One of our favorite in the service, and we have been long since January, is NEM, which has been one of the stronger, especially larger cap mining stocks. It's one of the few larger caps that has already exceeded the highs that were made last year, and in 2020, last year made a slightly higher high compared to the 2020 high. So it's already broken out in what looks like the next leg higher within this structure, another larger diagonal, so the bigger 5-wave move to compose of the trending move, but the subwaves unfolding as an ABC here. Similar to GDX, I mean, there's room to pull back, consolidate near term with support in the 74 to 72 region if we do consolidate a bit more. It has already made some decent progress to the upside and even can count as 5 waves up from the December low complete. So again, once 5 waves up completes, you get a corrective consolidation before the next higher degree part of the trend, another 5-wave structure to follow that 3-wave corrective pullback. So made some good progress already after December low. It's at a point where some near-term consolidation could be seen, but the expectation is any pullback is corrective and setting up further upside with an ideal target for this entire move off of the November low at a minimum in the 112 region. Another probably better known and larger component of GDX is Barrick. Ticker is GOLD. Smaller degree, it has a similar near-term possible path as that blue path on the GDX chart off of the high that was made at the beginning of March, where prices only filled out the A, B, and needs to head lower in this C wave. However, if it does continue otherwise back above the high that was made yesterday and above the March high, then that would suggest this pullback as wave 4 is completed already. Price is already working on the 5th and heading up to 28 to satisfy what would look like 5 waves up from the December low. Could then consolidate again from there, but expectation will be corrective before setting up further upside. So this, unlike NEM, hasn't made a higher high compared to the 2020 high, but has done more than enough to suggest that the correction down from that 2020 high is completed and price is set up for further upside overall. And so we have some time for some questions. I'm just going to do one more here. Sand is another of our individual mining stocks that we like for technical and fundamental reasons. It has already exceeded the high from March, so it looks more likely that our 4th has complete. That gold has GOLD. Barrick has not yet made that higher high to confirm the 5th underway. But there is room to stretch a little bit higher here in the 5th wave, head up into the mid $9 region as the ideal target before completing, 5 up from the December low, and then setting up the next corrective ABC before continuing the higher degree trend from there. So those 3 stocks, NEM, GOLD, and Sandstorm, SAND, are all constructive looking off of their lows that they made earlier this year or the end of last year, and do seem to support the expectation for further upside overall going into the end of the year. And eventually, aside from NEM, who is which has already made a higher high compared to the 2021 high and the 2020 high, set up for new highs, Barrick and Sandstorm, above the respective 2020 highs on those charts. All right, should have about 5 minutes for questions.
All right, Garrett, thank you so much. We had a question come in. They were wondering, what's your interpretation on where gold stands currently?
I assume that was not about Barrick, but just the precious metal gold. Hopefully my comments when we were looking at the gold charts have already kind of covered that. Looking for a little bit more confirmation of the bottom place to this wave 4 pullback and start to this fifth, but otherwise looking for further upside to 2150.
All right, excellent, thank you. Another question here, they're saying after gold reaches your wave 5 target of around 2300, what kind of retrace do you expect before resuming the uptrend?
So that was shown in the daily chart here, again, off of the March low from 2021. We're filling out what looks like a fifth wave, fractal nature of Elliott wave theory. That 5-wave structure itself subdivides into a 5-wave move. So pullback from the March high is wave 4 of this wave 3, which means once 2150 is reached, completes the wave 5 of 3 and then pulls back in the next higher degree wave 4 before fifth up to 2300.
All right, thank you. Another question just rolled in. They're wondering, is this move a wave 1 overall?
The move up off of the 2015 low, I assume.
Mm-hmm.
I'll make that assumption. So once we complete this 5-wave structure to the upside, for trading or investing purposes, it doesn't really matter. It's not a situation where I personally would want to hold at least gold specifically. There might be, certain individual mining stocks or other areas of the commodity markets that do look like they have some more near-term bullish potential. But once it looks like this 5-wave structure off the 2015 low completes, you're going to expect a decent correction that can take even several years to fill out. So not a period where you really want to be holding substantial long positions during that drawdown. And you wait to see how that structure unfolds. If it looks clearly corrective in that pullback, it's following expectations for those ABC moves that we expect corrective moves to unfold as, then a move back into support that we expect for wave 2, following what will be this larger wave 1 from 2015, would then be a situation where starting to reinvest money back into gold specifically would look attractive again. So usually I say it doesn't matter, because for trading purposes, we're not going to be trying to hold through that drawdown, and we'll see how the structure unfolds and make a decision after that.
All right, thank you so much. We had a few people, they were wondering, what are your thoughts on gold versus Bitcoin?
It's interesting from a fundamental perspective when we're talking about a hedge against rising real rates. The argument can be made that Bitcoin has now emerged as an alternative to gold in that respect. It has a lot more volatility in comparison to gold. So for some investors, it may not be nearly as attractive in that respect. And recently, at least, I don't believe that this correlation will necessarily last, but it has been a lot more highly correlated to equities compared to gold. So regarding it as an inflation hedge or a hedge against, more specifically, rising real rates, it hasn't been as successful in providing that hedge as gold has been so far.
All right, thank you. Do have time for one more here. They're wondering, with the sanctions taking place in Russia and with gold usually, excuse me, in a surplus, do we see ETFs mopping up the gold supply, bringing it closer to balance?
I honestly don't have an answer to that. I don't look at specifics like that. When I was looking at that gold versus real rates chart, I don't have to switch back to it, but I noted kind of that difference between the two that are usually fairly well correlated have kind of dropped from that correlation recently. And one of the arguments to be made, at least from a fundamental perspective, could be that it's caused by the current geopolitical situation that's going on. So yeah, if that gets resolved completely, does that mean that gold is going to pull back and reestablish that correlation? Or are we going to see the opposite and real rates start to back off and come back down, and inflation either come down or plateau in order to bring that ratio back to a rising gold price?
All right. Well, Garrett, that puts us at time. Thank you so much for taking the time out today. We really appreciate it.
Thank you very much. And if you are interested in learning more or checking out our service, elliottwavetrader.net, we offer a 15-day free trial, no credit card required.
All right. Thank you so much. And we will be back with more great content. Everyone stick around. Thank you again, Garrett.
Thank you.